Exxon Mobil, stock ticker XOM's recent financial results have been disappointing as they have missed consensus estimates on both top and bottom lines. The miss on numbers came after a couple of years of great growth for Exxon, and these growth bursts have now subsided. They are currently trading around $103. Year to date, they have traded roughly equal, down roughly 3.5%. Zooming out to 1 year, it's roughly the same picture, down roughly 8%. But zooming out to 5 years, you can see they have actually delivered quite good results, and the 52-week range is very close to the bottom. If you jump over and see the crude oil and Brent oil prices, you can see they have taken quite a dip over the last month or so. Valuation-wise, you can see the PE non-GAAP forward ratio for Exxon is quite low, around 11, versus a 5-year average of around 16, so roughly 30% below. Taking a look at the dividend stats, you can see they do offer a dividend yield of 3.71%, annual payout of $3.80, a payout ratio of around 35%, and a 5-year growth rate of mere 2.6%. Not great at all, but the dividend growth streak is quite long, 25 years, and if we jump into the history, you can also see here, scrolling up a little bit, you can see the consecutive years of dividend payments is actually 41 years, and if you see here at the graph, you can see they have gone back quite a lot of time. They did cut the dividend back in the 90s and then have focused on growing it ever since. Had a couple of years without growth in the 20s, 21s, but still they are delivering value back to shareholders. But let's jump into the financial statements to take a close look at some of the numbers behind. You can see revenue-wise, they are looking pretty good. Back in December 2018, $280 billion, up to $346 now. In December 22 and in December 21, you can see they actually had quite a big of a growth compared to 2020, obviously when COVID hit really hard. And so the post-pandemic recovery and increased demand for non-Russian oil and gas, and after the onset of war in Ukraine, you can see they really took quite a big leap up. But that growth has since subsided, and now we are a bit of a downtrend again to 346, up from around 400 billion. So while those growth sessions are over, Exxon has taken steps to keep growing. They're expanding existing facilities to meet current demands, transitioning existing facilities to produce biofuels and meet future demands, cutting costs and taking advantage of the decline in the share price to actually increase the EPS through buybacks. So they are taking a lot of good measurements from the board. I think they are really bringing the company in a very good direction. But let's take a closer look at the cash flow statements, which obviously also want to take a close look at. So net income wise, you can see up from 20 billion back in 2018 to 40 now. Again, it has taken quite a hit since the glory days back last year when there was so much demand for non-Russian oil. Coming down here to see cash from operations, we sit around 60 billion from the last 12 months, with the capital expenditures being around 21 billion. You can see there's plenty of free cash flow. If this can keep up in the future is obviously unknown, but hopefully of all the stuff they are taking upon themselves to expand the business and invest in themselves, hopefully they will bring new cash flows into the company and really be a very sustainable company in the future as well. Coming down to the bottom here, you can see the free cash flow per share sits around $9, so obviously way higher than the $3.80 that is required to pay the dividend. Before we take a close look at our intrinsic value calculations, I do want to check how Wall Street thinks about it, and as you can see, the analyst has it rated as a buy. 27 analysts in the last 90 days. Several of them has a strong buy, roughly 1/3. Then there's a couple of guys on buy, and then most on hold. Nobody on the sell side. So let's come down here to the average price target. You can see the average price target sits at 126, so indicating a 23% upside of the current levels. You can see even the lows are still a little bit higher than the current price right now. But let's also take a quick look at the earnings estimate. You can see last time they actually missed on the EPS, and for the upcoming quarter, you can see here is actually calculated in a bit of the decline on the EPS side. But if we come down here to the estimates from the annual side for next year, you can see they have actually estimated to grow it a little bit again on EPS, mainly due to share buybacks, I believe. So again, Exxon are really returning some value to shareholders, and I do believe that a steadily increasing dividend is also on the board for them. But let's jump into our stock screen and zoom in a little bit so we can see everything a little bit better. And then we take a close look at some of the key metrics. As you can see here, we do have our PE ratio way below the 5-year average, as we saw earlier. The revenue, as we saw, is quite large. They have a 5-year CAGR really high, but again, in the future, I believe this should probably come down a little bit. Net debt to EBITDA is looking extremely good. They have a lot of cash on hand, very low debt, or very manageable debt at least. So a net debt to EBITDA ratio of 0.13 is way lower than the 3x ratio I would like it to be at. Return on invested capital and return on equity are also looking extremely good. You can see the 5-year averages are sitting around 5 and 9 respectively. And now on return on invested capital, 19%, and return on equity, 28%. So really good numbers here. And as mentioned earlier, they are cutting costs, also improving the business that way. As you can see, the operating margin growth, 15% CAGR over the last 5 years, which is extremely good to see. And as mentioned, the dividend are looking really good. The payout ratio here sits way below the one mentioned earlier, but still, no matter where you look, if it's 26 or 34%, then it's also pretty good. The current yield sits at 3.5 as mentioned, but the growth rate is a bit slow. But again, slow and steady wins the race. Jumping into our dividend data tab here, and you can see in the table up here, I do want to have some steady growth basically. So you can see the 10-year growth rate sits around 4%, the 5-year growth rate at 2.6. So let's take a close look at some of the different years. You can see here, we had a big one back in 2014, and then 6.3, so on, so on. Very slow and steady basically. I think it's very manageable increases they have done. I think the 5-year growth rate sits roughly started at 5 and then it decreased ever so slightly, but sits around these 2.6, 2.7 roughly. So I think this is a very manageable and sustainable dividend growth streak they are going for. But let's jump down here to the dividend growth theory graphs. You can see 5-year dividend yield sits way below the line here. So whenever we come into the red area as we are here, it could indicate a potential overvaluation of the stock. And whenever we move up into the blue area, could indicate a good opportunity to buy. And you can see here on the graph on the left, the dividend theory indicates that there's no discount at the current time. Basically, the stock is overvalued, at least according to the dividend yield theory. But luckily, we do have a lot of other valuation methods, such as the discounted cash flow model. So if we see here, I've used some of the earlier cash flow basically because I think with the massive numbers they had in 21 and 22, I think it's very difficult to extract them into the future basically. So I have taken the liberty to try to just take a more reasonable number and then lower the growth rate a little bit. Still, it looks pretty highly valued on this one, I would say. But we do also have the dividend discount model, the multiples valuation, Graham's revised valuations, and a lot of other. So feel free to pause the video at any time if you do want to take a closer look at some of the estimates that I have done. And lastly, the Peter Lynch model. Before we jump into the summary, thank you so much for watching. If you haven't done so already, please subscribe to the channel for more videos in the future. Now let's jump into the summary where we do have all our valuation methods here. As you can see, some of them are very high, such as the Graham's, which is normally quite on the low side, I would say, and with the Peter Lynch valuation, which is also on the low side. If we jump back here to the Peter Lynch model, you can see the growth rate is actually estimated to be 45% annually. And I did double check this number in the analyst desk in Yahoo Finance, and it is actually this high. So I think this should probably be taken with a grain of salt, because I think 45% growth every year for the next 5 years is really massive. And I don't really see Exxon to actually achieve that one. But still, let's use them just because that's what the numbers say right now. We can always revisit it. Basically, this averages up to an average intrinsic value of $184. With the current price being $102, there's an average current discount of 44%. We do, however, also want to apply a margin of safety. So we use our margin of safety calculator over here on the right. You can see we start with standard of 25, and then depending on some of the key metrics, such as the EPS growth and payout ratio and so on, we either add or deduct a little bit margin of safety, which in this case end up at 0. So you can see here we start with 25 and then deduct basically everything we do, end up at 0. So we could transfer 0 over here to the margin of safety field on the left, which gives us an acceptable buy price of $184. I think this is probably a bit too high. I think there's still some upside, even though the dividend yield theory doesn't really agree with it. I think there is a pretty good buying opportunity here for Exxon Mobil. I think the steps that Exxon is taking, I believe they can maintain their position in the investment community. It's known for its generous shareholder returns and a steadily increasing dividend, and I think they will do that in the future as well. So for me personally, I would definitely take a closer look and maybe buy at the current levels. I think it's a really good opportunity for a very great company, a dividend aristocrat, and a very well-run company. And as mentioned, they have taken several steps to keep growing in the future, expanding existing facilities and transitioning existing facilities as well to produce biofuels and meet the future demands, because at some point, obviously, we do want to take a switch away from oil. So there needs to be some future energy sources and so on. So I think it's a very nice route that XOM is going for right now. So thank you so much for watching, and I'll be seeing you in the next video.